Welcome to Be the Boss of Your Money. I'm Mitch Goldberg, your host. This is my live stream every Monday through Thursday at 4:30. It's all about personal finance, credit, credit scores, investing, borrowing, saving and paying for college, retirement income strategies, budgeting. We talk about all of that right here on Be the Boss of Your Money. Today, though, we've got two huge pieces of news. You might think, well, what could there be besides the fact that the stock market hit a new record high today and completely regained and surpassed all of the losses from last week? And everybody thought the world was ending, but we said, no, inflation looks to be temporary. Biden is up. Powell is on it. But there's another big piece of news. It literally came out just as I was hitting the live button. Let me just make sure we're all in here. Okay, it looks like everybody is in the house. All right. Make sure we're set up on LinkedIn. So the big news, the Federal Reserve gives U.S. banks a thumbs up. All 23 lenders that went through the Fed's stress test have all easily met their goal. So that is huge, my friends. So we are very excited about that. It looks like okay. It looked like LinkedIn wasn't picking up our recording, our live stream. It looks like LinkedIn wasn't picking up our live stream for a moment, but we're in there now. So if you're just joining me, welcome. This is Be the Boss of Your Money. We're talking about the stock market hitting new highs. All 23 financial institutions that were judged in the Federal Reserve's stress test passed easily. And we have some good things to look forward to, like dividends and buybacks. This is huge news. I mean, this is, to me, way bigger than anything else. Even the infrastructure deal that was agreed upon. Wow, we've got a lot to talk about. So let me just roll the intro, and we're going to get into the whole kit and caboodle. Here we go. Here's the intro. Boom. Okay, we're back. I think we're just going to have to go it alone without everybody in LinkedIn land. I have a note from one of my tech providers that this may be an issue on LinkedIn's end. So hopefully, if you do tune in eventually and watch this, you'll know why. And when LinkedIn does show up, we'll welcome everybody again. Couple of big things to talk about, like the thumbnail says, stocks reach new record on infrastructure deal. Yesterday, we spoke about stock market finds its balance, and that certainly goes today. You know, when the market finds balance, I've been saying this, for the better part of a week now. I've always been saying this, but I don't like the big ups and big downs. It's just volatility. We got back to some equilibrium yesterday. Today, we not only won back all the losses from last week, hit new gains, new highs. So look, the last time the S&P hit new highs was 2 weeks ago. But last week, you'd think it was, 2 years ago. We're back. What for? Biden comes out and says we have a deal. That's what I was thinking President Biden before. It looks like Democrats, Republicans reached the deal on infrastructure. It's not as big as some wanted it, bigger than some wanted it, but it is the kind of infrastructure that we think of when we talk about infrastructure. And it's meaning, roads, bridges, tunnels, that sort of thing. But more importantly, it's the jobs. Okay. It's the jobs that come with this kind of infrastructure. Heavy machinery, moving materials all around, $1 trillion infrastructure package. Do you have any idea how much in materials and gravel and asphalt and trucks and drivers and heavy machine operators, and the amount of labor that this is going to take? It's a deal over 5 years. It's going to juice up the economy. The good thing about infrastructure spending, though, is once you get the spending done, it pays for itself. Let me explain. Obviously, there's tolls and all that, but it's less wear and tear on your cars, on trucks. I mean, how many of us every time we drive out now, we have to wonder if this is the day we're going to hit another pothole and get another flat tire. I have so many friends who have tire insurance, at least in New York. I don't know how it is by you, but the roads up here are pretty crummy, and just the winters are just destroy the roads. There's little cracks in the roads. Water gets in the cracks. The water freezes, expands, and makes the cracks bigger and bigger until the roads just crumble. So that's big infrastructure, big jobs. So that is a huge thing, and that's what helped move the market today. There was something in it for everyone today, but in particular the industrials, the economically sensitive stocks. But more important is the Federal Reserve passed all 23 institutions that were undergoing the Fed stress test. In other words, if there was a severe recession, 10.8% unemployment, and a 55% drop in the stock market, how would the banking sector do in that case? And they've passed with flying colors. I mean, our banking system is so well capitalized, nothing like 07 and then 08 in March of 08 when Bear Stearns collapsed, and then September of 08, Lehman Brothers collapsed. So this is huge. And I want to just put up a watch list and just take a look at how the financials are doing. Okay. And I want to get the after hours quote. Okay. So let's just go let's take it to the tape. I'll put myself up here in the corner. Let me see if I could make this a little bigger so you could see it on your smartphones. All right, here we go. This is aftermarket trading. Morgan Stanley up 1.39%. This is on top of today's gains, by the way. Bank of America up, Goldman Sachs up, Wells Fargo is up, Citigroup up, JP Morgan up. If you look at these little lines over here, the variance between the high and the low, the delta, the spread, I like the delta. Alpha, Bravo, Delta. I left that Charlie. So, man, LinkedIn is just not going to come in. Anyway, the bank stocks still have a ways to go to get back to their old highs. For example, Citigroup is 70, just about 72 aftermarket trading. It's more than 10% below its high. So bank stocks did have a pretty substantial correction, but they're going back up. And let's take a look how they did in regular trading. And they were up nicely in regular trading as well. Even Coinbase. I know Coinbase is not a bank stock, but I have it with my financials. It's just the way I think of it because it's an exchange. Bank of America was up already. Travelers, IAT, that's regional banks, JP Morgan. So we had a pretty good day for these stocks. Let's take a look what else happened while we're on the watch list. Okay. Let's take a look at my new FANG M list. It's not really a new list, but if you're a viewer of the show, the N always stood for Netflix. I said Netflix. The N always stood for Netflix. Now it's for NVIDIA. But NVIDIA hit a new high again today, but up $5. NVIDIA, Facebook up, Microsoft up again. Google doing great. All right. 24.61.11, 24.60. We're just getting new highs all over the place. Apple continues to struggle below its high, but not off by much. And Amazon is not far from its high. So when you have these big market cap stocks, huge, tremendous stocks go up, that helps lift the whole market. And let's take a look at what else did really well. We'll go into the sector ETFs. Okay. Financials led the way today. When you see financials lead the way, that is a vote of confidence in the stock market. That's a big vote of confidence. So we like to see bank stocks, making sure the mic's in the right place. We like to see bank stocks go up because that means the economy is expected to do well. Bank stocks are bank stocks are a leading indicator. Communications did pretty well. That has a lot of Netflix, Facebook, Google. It's believe it or not, the communications XLC is it's basically another tech portfolio tech. These are the major ETFs that track the 11 major sectors of the U.S. economy, by the way, if you want to know what this list is. This is the main thing I look at. Energy continues to do well. Industrials rebounded, still a little ways off their highs. Consumer staples rebounded a little bit off their highs. What was at the bottom? Economic interest rate sensitive utilities and real estate were down. This is just basically a reversal of what we saw last week. And so that's that one. And I want to just get off that screen and let's move on to how the markets are today. So the Dow is up 322 points, NASDAQ up almost 100. 100 points used to be a big deal for the NASDAQ, not anymore. I remember when the Dow first hit 14,000. Now the NASDAQ is at 14,000. S&P up all-time high. I see a lot of year-end targets for the S&P 500 at around 4,300, 4,400. I wonder if a lot of the Wall Street investment strategists are going to start raising their year-end targets for the S&P. Gold off. Why is gold off? Investors aren't really as worried about inflation. I think investors were worried that the Fed would let inflation get away. Then last week, investors worried that the Fed would get too aggressive to tamp down inflation. And now this week, we're just back to the Goldilocks scenario, right? We're back to Goldilocks, where everything is not too hot, not too cold. It's just right. Okay. That little bear has got it going on. Oil up a drop. VIX continues to come down to the 15s. I mean, that's pretty low. For a long time, we were in like the 10 to 12 range, but we're getting back there. And let's just go down to take a look at the small cap stocks. Up again, up 1.31%. Standout winner in small cap stocks, 1.131%, beating all the other major averages. That tells you that investors expect the U.S. economy to do pretty well. And that's been doing well. It was up yesterday. We spoke about this, that when small caps do well, they're more sensitive to the U.S. economy. They get the bulk of their revenues domestically. And since they have a harder time raising money than big companies, when they're doing well, that really tells you that the U.S. economy is in good shape. So that whole thing last week was just a blip. And some of the things we talked about last week, I don't mean to do the I told you so stuff, but stuff last week we spoke about. Stuff. I said, I'm not really worried about the inflation concern. I do think it's transitory. I've been saying that for months. I'm in the transitory camp with inflation. I've also been saying that what the Fed is doing is good. I'm glad the Fed's acknowledging inflation. If they came out last week and said, after their big Fed meeting and said, oh, we're not worried about inflation, we're not going to do anything about it, people would get scared. That would be the worst thing. Look, really high inflation is bad for the market. I don't think we're getting really high inflation. It might seem like that, but that's because we're comparing prices to the bottom of the recession caused by the pandemic, the shutdowns. As those months roll off, the price gains aren't going to be as substantial, which is what we expect. What else? We said, don't just pick industrial stocks or the secular technology stocks, secular growers. You want both, and you want to do a little bit of rebalancing maybe when one gets too big. Put some money into the other one, and go back and forth. Diversification, right? That's a strategy that we use to reduce risk. It might not protect your portfolio from going down in the generally down market, but it could help your portfolio go down less. Certainly could help your portfolio from being overly influenced by the worst performing investment in your portfolio. It's a strategy that reduces risk, not maximizes gains. Okay. So we have some people out there. Hey, Bill is out there. Hey, Bill, how are you? So nice to see you. And thank you very much for joining me. And it's good to see you, man. I haven't seen you for a while. I really appreciate that. I get a little giddy with Bill when you're there, man. Thank you very much. I really appreciate you taking the time. So those are the big things. So the infrastructure deal is huge, and that's great. But the bank stress tests, all the banks pass. Let me explain what this means. Banks can now raise their dividends. So that brings to me, that'll bring a whole new rush of investors into bank stocks, because everybody's looking, not everybody, but a lot of investors, boomers especially, are looking for attractive dividend yields that they could count on. It also allows for banks to do stock buybacks, which is good for capital appreciation. So you just have you have an amazing set of circumstances for bank stocks. Now, if we do see interest rates go up a little bit, okay, the 10-year Treasury went out today unchanged at 1.49%. But if you see the yield in the Treasury, 10-year Treasury move up a little bit, and those spreads between short rates and long rates widens, that's really good for banks too. Why is that? Because banks, their cost of money is very low, and they lend to you at higher rates. Okay, so their cost of money is short-term rates. Your cost of money is long-term rates. So banks pocket that difference. All right, so that's really about it. If you have any questions, ask me now. It's Thursday. It's the last stream of the week. We are at record highs in the stock market. The worry over last week has gone away. And last week, when we talked about making changes, you know what we spoke about? I just want to say this is, don't try to time this. Make your investment decisions really based on your own personal finance. You know, you could say, hey, listen, I'm 11, 12 years older since the last recession. You know, the Great Recession anyway. Not the last recession was March of last year, but whatever, you get my drift. You're older. Maybe you need to reduce some of your stock exposure because stocks have been going up and up and up, and you're so overexposed to stocks, but you haven't really looked, haven't done anything because maybe you got a little bit complacent. And why fix what's not broken? This has nothing to do with fixing what's not broken. Your personal finance, your time horizon to when you're going to need money for your financial obligations is rapidly approaching. Then you need to make adjustments, reduce your stock exposure, unless you've done that already. Now, presumably, we have all reduced our stock exposure in advance of needing money for a financial obligation. But if you haven't done it, let last week be a wake-up call for you. Phil is out there. Hey, hi, Mitch. I think that the infrastructure bill will fuel more inflation. Not transitory. We shall see. You know, yesterday you make a great point. So, you know, if the infrastructure deal is for 5 years and there are supply constraints, and now not only their demand increases, but there's going to be a big woof of demand. And it might not just be in the United States. There's infrastructure needs, you know, all over the world. So maybe the word transitory is the wrong word, and it's more long-lasting, more grounded. I don't know yet. I do think that supply chains were pretty messed up because of the shutdowns. And by the way, the shutdowns are still going on. We're very fortunate in the United States that we're coming out of it, but they're still going on in most of the world. But will supply come out? I do believe that we have incredible capacity as a society to generate more capacity when we need it. I also think that technology and automation will continue to tamp down inflation for better or for worse. I say that for better, for worse, because, you know, automation isn't always so good for salaries. So we shall see. If it's permanent or, you know, what I said yesterday was, I have a new definition for transitory inflation. It'll just be transitory for longer than we expect. So is that really transitory? I don't know. Is there a word between transitory and long lasting or permanent? That's the word I'm going for. If you have the word for it, let me know. I'm going to have to find that word or make a new one up. Okay. But I do think the supply constraints come back, and I think humankind is great at finding more supply of whatever it needs. However, if the inflation does pick up because of the government spending and because the economy is doing well, that's okay as long as, you know, earnings are holding up. The real problem with inflation, people might think, well, if the economy is doing well, then what's the big deal? If corporations have to pay more money for the cost of their inputs, and they can't pass the costs to their end users, their consumers, then corporations' profit margins shrink. If they could pass it to the end users, like let's say consumers, and now the consumers say, I can't buy as much stuff because money's not going as far, well, then that causes a slowdown in demand, weakness in demand, and that's also not good. So is it good that the Fed has woken up and said, hey, you know what? We are looking at tapering and raising rates. And some Fed officials are talking about raising rates as soon as next year. I think it's good. I think it keeps us in check as well. But we'll see. This is why we're diversified. We could go on and on about like what's going to come first, the chicken or the egg. I appreciate that, Phil, and it might not be transitory. I think we are ready for either scenario, though. But if inflation really gets out of hand, like really goes up a lot, I don't think there's really much of anything that could be done. I mean, what are we going to do? Put every dollar for all investors? What do we all do? Just put all our money into iron ore? Inflation is cyclical, and I know someone's going to say, well, cycles could last for decades. And when you're at a certain age, you don't have decades. And that's why we have, intermediate, moderate, aggressive, and conservative portfolios and lots of inflation protected securities, things like that. All right. I hope everybody has a great weekend. Thank you so much for joining me. Your time is very valuable. And it just means so much to me that you guys took the time to watch my live stream. And I hope it puts things in perspective about what's going on in the financial, economic, political landscape. And this way, ultimately, we make better financial decisions, better personal finance, better investing decisions. And it helps us be able to stick with what we have. I mean, can you imagine investors who bailed out of their stock accounts in March of 2020, were just bailed out of everything last week because they were worried about a major change, and that's it? These are the kind of things that we need to avoid. And I think it's just, I look at myself as a financial coach in a lot of ways, and it's just like we need consistent coaching to stay on top of our game. You can lean on me. All right, now I'm going to end the broadcast. Thank you all. Peace. Happy Friday tomorrow. And I can't wait to see all of you on Monday. Bye.